Hi, my name is Udit and I work in Germany as a finance manager. In today's video, we are going to talk about the impact of additional tariffs imposed by the US on other countries, its impact on the economy, global financial markets, and more importantly, towards the end, I'm going to talk about what should you do in this kind of a situation. In the past 1 month, we have seen the markets across the world falling very sharply, reacting to the news of tariff imposition. The S&P 500 is down by 12%. The DAX 40 in Germany is down by approximately 14% in the last 1 month. And similarly, the markets across the world have fallen sharply reacting to this news. Now the question comes is, what exactly is a tariff? Tariff is basically a kind of a tax that a country imposes on the incoming goods exported by the other countries into its boundaries. So in this case, what the United States has done with the latest notification is that on top of the existing tariff, which was the existing duty on the products, President Donald Trump has imposed additional duties for each country on top of the existing duties. And this is leading to the panic in the stock markets and also the global economic world order. For example, US has imposed 34% additional tariff on China, which means that now the goods which are exported from China into the US would attract 34% more duty than they attracted earlier. Similarly, the tariff imposition on the EU is 20% and on India it's 26%. This additional duty is on top of the existing duty that was imposed on all these countries. Now the question comes is that what is the impact of this additional duty on the overall economy and the world order? Let's do a first order economic analysis of this situation. When the tariffs are imposed, the cost of the final goods increases for the importer. The importer may choose to do away a part of it by absorbing these costs. This would lead to the shrinking in the margins of the importer, or the importer may choose to pass it on to the end consumer. Most likely the costs are passed on to the end consumers because the margins are not so hefty. What it leads to is the increase in the end consumer prices. And what happens when the prices go up for the goods coming into the United States from these countries at a higher tariff? The demand slows down because the consumers are not willing to pay that extra price to buy those goods. And this decline in the demand leads to a slowdown in the overall economy. So institutions like Goldman Sachs and JP Morgan have given a probability of US recession somewhere around 40%. What it means is that this demand slowdown in the United States would probably lead to a recession. Now, this is the story about the United States. What comes next is the impact on the other countries. So the countries which were exporting to the United States, they will witness a decline in the demand of the products that they were selling to the United States. And when the demand falls down for their products, the revenue that these countries were generating out of the US also goes down. And there's a very high probability that these economies would go into a slowdown or a recession. The other impact that this tariff imposition is going to cause in the global world order is the decline in the reputation of United States as a reliable trade partner in the global world order. And this is because the United States unilaterally imposed all these additional duties across the countries without coming to the negotiation table. So in a nutshell, this is a very uncertain situation. It is a macro situation which has a lot of moving parts. So we cannot be sure of how this is going to play out in the short to medium term. Since this is a complicated situation and nobody can be sure because the situation is evolving on a day-to-day basis, and it is also a function of the decisions that the leaders of all these countries are going to take to counter these tariff measures and protect their own economies. Now, the question comes is that what should you do in this kind of a situation? The first thing is that we need to keep calm. Yes, unless we decide to go back into the stone age and live back in the caves like our ancestors did, there is no need to panic. The world has evolved to a very large extent from the stone ages, and we know how to collectively solve our problems. This reaction that we see in the financial markets right now is more of a panic reaction because of uncertainty, because the markets in general don't like uncertainty. So sit back and be patient. Wait for the storm to pass by. In case you're already invested, hold your investments, don't sell in panic. In case you're looking forward to invest more, continue with your own asset allocation and deploy the money in the equity markets, considering your asset allocation, your investment plan, and your investment hypothesis. In case you are still not very comfortable with the situation and you think that the world is going to the dogs, then you can choose to sell a part of your portfolio just to avoid stress. The history says that the market is full of such situations and it has always recovered. But our peace of mind is of utmost important. In case you are losing your sleep, in case you're not able to manage your emotions, then you can of course sell a part of your portfolio without any regrets for the future and sleep in peace. But my advice would be to stay put and stay calm and let the storm pass by, like I said. In these kinds of situation, asset allocation matters the most. Let's say if you don't have any asset allocation plan and you are invested fully into equity markets, then your portfolio goes down by 10, 15, 20% in these kinds of scenarios. Maybe it does not recover in the next 2 to 3 years, and then you feel stuck. So it's very important to have a proper asset allocation in place. And like I've said in my previous videos, we only invest the money that we don't need for the next 5 to 7 years in the equity markets. Don't be here for the short run. Be here to invest for medium to long term. If you are invested for the next 10 years, this is going to be a very minor disruption in the overall investment journey that we have to traverse. So stay put and don't look at your portfolio every 1 hour, seeing where it is going, how much is it moving up or down. Just be calm, be composed, and more importantly, focus on your primary source of income, which is your primary occupation. This can be your job or business. Focus on growing your skills, focus on growing your mindset, focus on having a detached mindset wherein these kind of market moves don't impact you emotionally and your well-being is not hampered by these kind of market moves. Because remember, this is the price of admission in markets. When we enter the markets, when we start our investment journey through equity markets, volatility is the price that we have to pay. It is not going to be a smooth sail, and history has taught us that it was never a smooth sail. So we have to accept that this is the innate nature of the equity market, and volatility is an intrinsic part of our equity market investing journey. So be calm, be composed, focus on your individual growth, focus on your primary occupation, focus on controlling your emotions, and never forget the mantra of life. Keep walking and growth is life. Thank you.